They are terrified. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, the political elites are panicking as the unthinkable looms. And with the stock market at all-time highs and even the bond market rallying, which is taking pressure off of the Treasury and having to fund these outrageous deficits, you might think that everything is okay. But the recent moves by the political elites show that they're more concerned that the unthinkable is coming. And when you understand this, it'll make perfect sense why they're actually panicking. Now let's head over to the Wall Street Journal because I want to take a look around the world where we're actually seeing some signs that maybe everything is indeed okay. But as you're about to see, underneath the surface, we're far from it. And Country Gardens decided to make a disposal of assets to aid their debt restructuring. And again, this looks like a really good move because we've seen that even though Beijing is attempting to bail out the banks to indirectly bail out the property developers, well, we really need to see the property developers making some moves here and Country Gardens making a what would appear to be a really wise move. Let's dump some assets, let's restructure some debt, and show that everybody that we're indeed financially solvent here, and that way everyone can come and continue to buy our houses, and next thing you know, the economy will turn around and everything will just be okay. In fact, Chinese property giant Country Garden will sell a stake in commercial center operator for about $428 million and use the proceeds to help restructure offshore debt. Now, if you're not familiar with the term between onshore and offshore, offshore meaning dollar-denominated debt. Now, of course, one of the bigger issues here, we're in a massive global dollar shortage, which is only getting worse, as you're about to see, based on the moves the Fed made yesterday and their decisions about where they're going for next year. And of course, that's because the Fed is really concerned about the unthinkable that's coming. The indebted developer said Thursday that the group's subsidiary will sell its entire 1.79% stake in Zhuhai Wanda Commercial Management Group for about 3.07 billion yuan. The net proceeds of this disposal will be used to restructure its offshore debt and in turn make those bondholders super happy, and that would, of course, regain confidence. And that's the whole game here when you're in a debt-based economy, is to give the air of confidence that indeed Country Garden is solvent. And of course, that gives the banks confidence that Country Garden will pay those loans back, even though Beijing said, look, you're going to lend to them no matter what they want. But as long as the public view, which is all that matters here, is that this developer is in good shape, means that people might return to buy their homes. But if they don't, well, watch out below. And another place that is lacking in confidence and hoping to gain it, well, as we head over a little bit further to the east, well, that's Japan. As Japan agrees tax cuts to support households in an effort to defeat deflation. Of course, Japan has been mired in deflation for decades. And you want to talk about a series of policy failures after another one. They're doing everything they can. They finally get a little bit of inflation, and they know that it's not sustainable. It's already starting to turn over and head down because we are in a globally synchronized economy. And so, in their infinite wisdom, the political elites there think that maybe a tax cut will actually spur growth. Well, in reality, as we know, the Japanese are more likely to save it than they are to spend it. The tax reform panel of Japan's ruling Liberal Democratic Party has agreed on income tax breaks aimed at offsetting the pain of price hikes on households to help change, get this, decades of deflationary mindset. Of course, that is the issue here, is get people to change their view. Again, this is looking back at Country Garden. Change your view of this company and their solvency. Go buy a home. Get Japanese consumers to change their view. What the Fed did yesterday was actually to get people to change their view. But what you don't understand is they're concerned about something far worse than what appears to be that they've actually nailed what they're hoping to achieve as of a soft landing. We have some more evidence we've been talking about on the show the last couple of days about how we're seeing a pickup in layoffs here and there. And at first it seems, well, it doesn't make big difference. But it actually, when you start looking at what the executives are saying in the reports, you see that the underlying U.S. economy doesn't look anything at all to represent just what the stock market is trying to tell us. At one hand, the stock market is saying everything's great, but you're out to see underneath, well, not so much at all. As Etsy to cut 11% of marketplace workforce in its restructuring, here we have another issue, but look at this. The company is reducing its workforce as competitors, including Timo and Shine, which recently filed to go public, will steal market share with aggressive marketing against, but here's the key part, amid a broader consumer shift away from discretionary spending. But yet we've noted here recently that even services demand is down. So what we're seeing here is that everybody's not sure of what's actually going on. We're seeing a contraction in money. And because of that, someone like Etsy says, well, people are shifting away from their discretionary spending. The reality is people don't have the money to fund their discretionary spending at the same level. In fact, Etsy even admitted that. Here you can see the CEO said that the marketplace is still more than double its size it was in 2019. But get this, its gross merchandise sales have, quote, remained essentially flat since 2021, providing evidence that indeed consumers are short money in all sorts of ways. But one area that kind of is changing that view is as we look at retail sales here, because today, well, everyone got really excited as U.S. retail sales unexpectedly rose to start the holidays. And here we see November purchases jumping, and that gets everyone excited, of course, as we head into, of course, the final holiday season. And that matters because in a lot of ways, what you see is that consumers are indeed cash strapped. And I want to make that case, and we see that all over the world because we're saying they unexpectedly rose. Well, I'll tell you something that you should be expecting to rise. That's your trading account. In fact, we make it just that easy for you, as you're about to see here, as we look at one of our trades on the bond market, which is just outright exploded. Many people said there's no way bond prices are going to rally. And we said, yes, it's just as easy as shopping online. You get to our CTA Timer Pro. What did we show you? The machine positioning was at max short levels. We tell our subscribers, when you see it flip off of this level, that's where you want to look to take a position. That happened on November 2nd. On a pair trade, we have Momentum Timer Pro. This looks at all our technical signals, because the big difference is here, when we have machine positioning and we do a historical overlay, it's so easy. And then you pair that with the technicals, all those things that use signals that you're really confused about, we make them easy. One daily buy count. Here you see it on November 2nd. That would have triggered a buy at open. You would have bought here right there on this little candlestick here. And trading the long bond, you'd be up over 13.5% right now. That is incredible. There are indeed links in the description below, and for both of those reports with a coupon for 3 people to grab a free bond. And what you can see is one trade could change everything, give you all the research you need for many years. But now let's go back and talk about what's going on here with retail sales, because notably the value of retail purchases unadjusted for inflation increased 0.3%, but the figures for the prior month were revised lower, and excluding gasoline, sales rose 0.6%. So what actually happened is that we note that gasoline sales, of course, went down. We've been noting that there's been a build in inventories that went into retail sales, which is pretty notable. But one thing they note is that retail sales aren't adjusted for inflation. As you've seen on this graph here, well, we adjusted them. In fact, they're not that good, because if you're a retailer, you need to see retail sales growth above the rate of inflation, because you can look back to the dot-com bubble and what happened when retail sales adjusted for inflation don't keep up. Well, that means you're in a recession. You see that in the global financial crisis, the pandemic, obviously. Look now, everyone says we're not in a recession. The stock market's near all-time highs. Everything's got to look good. But retailers are hurting, my friends. That's the point I want to make here as we look forward to what is coming in the economy. You know, it's not about the stock market. Everyone looks at that and you can think, well, that must be a proxy of where the economy is going. Underneath, there is a deep amount of pain. And that's exactly what the political elites see. Consumers are holding in better than expected, particularly as they contend with lingering inflation and elevated borrowing costs. The labor markets continue to defy expectations for a slowdown, giving Americans the power to keep spending, especially with lower gas prices. Now, isn't that the case that we've been making this whole time, is that OPEC was trying to drive gas prices higher by tightening supply. And what did I say they needed to do? Was actually cause prices to go down, to flood the economy with energy, get prices down. down, and that will give more consumers around the world margin for their discretionary spending. And we see that last month. There's another reason it happened, but you're getting some idea here that as long as OPEC is attempting to keep prices higher, it's bad news for American consumers. You get energy prices down, you can get consumption back up, you can revive the U.S. and global economy at the same time. But the data this morning are stronger than expected across the board, showing that November, a clearly strong month for U.S. economic performance after a soft October, suggesting to us that consumers came out and spent big. But there's exactly a good reason why they did, because there was something had to do with what's called total compensation. And here you can see advanced retail sales adjusted for inflation. That's still in blue against total compensation, which is average hourly earnings of production and non-supervisory employees multiplied by the average weekly hours. And you can see right here, there was quite a jump in total compensation there, and that backfed right into retail sales. But what's notable is not a whole lot of it went there. We saw this boost in retail sales despite a much larger increase in incomes, suggesting that people are still gripped with inflation. They're dealing with higher interest costs on their debt. They've got other places to spend their money, but they still came out and spent. In retail sales, 8 out of 13 categories posted increases, led by restaurants and bars, the only service sector category in the report, as well as sporting goods stores and online retailers. Gasoline sales dropped nearly 3% as pump prices continued to fall in the month, despite the fact that consumers said they're going to rise. And meanwhile, department store sales declined by the most since March, reflecting tepid Black Friday shopping. So it looks like people were out drinking and eating and having a good time. And while that alone could help drive the economy, as we look forward to what the Fed did, it's not so much what they did, what they said is coming is the bigger issue. Everyone thinks they've got this. Everyone believes the soft landing is real. And wait till you show you, it's the unthinkable. This is what the Fed's really worried about, is they've got it all wrong. But here we can see the retail sales burst of excitement isn't going to continue, because here we see advanced resale sales adjusted for inflation in blue against the net percentage of domestic banks tightening standards for credit card loans. And we can note that while consumers are pushing to the red line of their limits on their credit cards and draining their savings, what it tells us at some point, as you can note, when banks tighten standards, that means consumers can't go out and spend, because Americans pay today, buy things today with money they don't have, and pay for it, well, sometime down in the future when they cannot charge stuff, they quit spending. We see this happen in every cycle. We know the banks are tightening standards, and we know those standards are going to start getting tighter, as you're about to see. Because the Fed prepares to shift its rate cuts in 2024 as inflation eases. And now on the surface here, this caused a huge rally in stocks, because everyone championed, said, hey, this is a soft landing. They've got it. They see it coming. And all they have to do is just pull back a little bit, and the economy is going to continue to roar. The bond market reacted, saying, look, we know rates are coming down, so that meant bond prices are coming up. This was a great benefit for Janet Yellen, who's got a massive deficit to fund, giving them some breathing room, despite all the people that claim that rates have to rise because of all the issuance of debt. We told you that's not how the system works. But as you're about to see, the Fed's not planning perhaps cuts because they think they've got it. They're planning them because they're worried. While Chair Jerome Powell said Wednesday policymakers are prepared to resume rate increases should price pressures return, which we have notably shown on here repeatedly that that's highly unlikely to happen. I think the market knows it too. He and his colleagues issued forecasts showing that a series of cuts would be likely next year. This is in terms of what's called the dot plot. Now, Powell said the topic came up at their meeting where the Fed decided to keep rates at a 22-year high for a third straight time. But what happens is they have these things called the dot plots, where the members of the FOMC board put some projections out where they think the federal funds rate is going to be. And what they determined is there's potentially now 3 rate cuts coming next year. But here's what I want to share with you. If you think that these dot plots are accurate at all, they're one of the most inaccurate, if not the most inaccurate data series available that any Fed official has ever created in the history of time, because they do not predict any sort of future. They think what they're going to do, and they end up doing something completely different. Now, does this mean they're going to raise rates? No. As we're about to see, they're going to massively end up cutting rates, but it's just the initial projections that everyone gives everyone the confidence. Again, it's all about perspective that we're going to achieve a soft landing, and then they're going to wake up and find out, no, we're heading to a hard landing. As less than 2 weeks after saying it would be premature to speculate on the timing of rate cuts, Powell said officials were starting to turn to that question. And that's what they do because it begins to come into view as clearly a topic of discussion out of the world and in course discussion or a meeting today. And they do have to do this because if they did hit their target, which of course we know they will, then of course they claim that they were going to dial back on the rate hikes a little bit. So this is exactly what we would expect to hear from the Fed. Inflation continues to come down. They're starting to believe it. And then they realize that they think that they can just get this dialed in like a finely tuned machine, that they've got it this time. Of course, we know that's not at all. In fact, it has nothing to do with any of the data. Everything to do with the bond market. Because here we can see the federal funds rate is really priced based on the 2-year Treasury yield and has nothing to do with any of the economic data or that they think inflation is coming down. What it has to do with the fact is a 2-year yield shown in red, as you can visibly see, lead the federal funds rate lower. So that tells us that the market is not confident that the Fed has positioned correctly. Look what's happening now is a 2-year yield has peaked and starting to come down. And that is telling the Fed that, hey, wait a minute here, you might be in the wrong position, and that's why they're starting to talk rate cuts here, because if the 2-year yield continues to fall, of course we'll make the case that it is, that means the Fed's in the wrong and they need to drop rates down, and that's exactly what's going to happen. It's not going to be a couple cuts, it's going to be a lot of cuts. An updated quarterly forecast show Fed officials expected to lower rates by 75 basis points next year, a sharper pace of cuts than expected in September. And while the median expectation for the federal funds rate at the end of 2024 was 4.6%, individual expectations varied widely. Meanwhile, the 10-year Treasury yield is under 4%, telling us that, again, the bond market says, look, Fed, you went too big, too much. You're wrong. You're going to cause the economy to crash here. The Fed is starting to worry because what they want to see here, and this is my point, they know the unthinkable is coming because the bond market is telling them. Everyone thinks that falling rates is a good thing. It is not. It actually means that financial conditions are tightening. Yes, if you own bonds, it's great. You're happy. It says, hey, wait a minute, instead of getting crushed here, I'm making some money on top of my yield in terms of duration. That's one side of the story. But in terms of how their economy actually works, it tells us financial conditions are tightening. This is not really what the Fed wants. They want everything to moderate, and it's not. For months, Powell has made reducing inflation his singular mission, and he warned that quashing it will require some pain. The deceleration in price increases has been mostly pain-free for workers, although the sought-after soft landing in the economy remains far from assured. And based on many of your comments, I don't get the impression that it's been pain-free for a lot of you, or for many Americans. But meanwhile, Goldman revises the Fed call, seeing earlier and faster cuts. Well, we agree with Goldman in this case, as our economics team anticipates the Fed's preferred inflation gauge, the core PCE price index, which includes volatile food and energy, will slow to 2.1% by the end of the next year, although I'll make the case we'll probably get there sooner. In light of the faster return to target, we now expect the FOMC to cut earlier and indeed faster, and that's the idea, is the Fed actually got it here, and they just need to make some adjustments, and then everybody's going to be happy, stocks are going to roar, the economy is going to boom, the labor market's going to take a flight off, and what's going to happen in inflation somehow is going to stay low. That's not how any of this indeed works. You watch and see. As economists expect, the Fed's easing will end when the benchmark rate hits a target of 3.25% to 3.5%. And based on the direction where the 10-year is headed, well, the bond market's saying you're going way below that. The current range is still 5.25% to 5.5%, and policymakers, as we know, estimated 3 cuts for next year. And it's Goldman. Their team highlighted Jerome Powell's assessment from earlier this month, describing rates as, quote, being well into restrictive territory rather than just restrictive. That's the idea, is, again, we just need to dial this back a little bit, and we've reached this magic equilibrium. Here is the reality. Things are going to get so much worse because the bond market is telling us. The key thing to understand is when rates fall, financial conditions tighten. And the problem here is banks needed higher interest rates so they could lend more, and they didn't because the Fed inverted the curve. Now rates are falling, suggesting to the banks that if you were going to lend, you're now going to lend with even less margin for error. That means that banks are not going to want to lend at all. We're going to see further tightening financial conditions, and we can note that when banks tighten lending standards, here you can see that in blue from firms of all sizes of commercial and industrial lending. What happens if the Fed ends up cutting rates massively? We've been at zero once, we've been at zero twice. Guess what, my friends? We're going to be at zero 3 times. And here you can see what that means for interest rates. Here we have the yield curve. This is the 10-year, 2-year, where you take the 10-year yield and subtract the 2-year yield. The inversion means the 2-year yields are higher than 10-year, which they currently are. We suspect that this is going to shift in a massive way here in the near-term future. The reason for that case is, as you can see right now, when we look at 2-year in blue, 10-year in red, what we can notice the 10-year starts the lead of the way down, which is what we're seeing today. And then what happens if the 2-year yield starts to tumble rapidly? It's game over at this point. It tells us the Fed made a massive mistake. They over-tightened policy. They kept the curve inverted for far too long. The system's run out of money. Yields are collapsing. And next thing you know, we're in a recession at best. And at worst, we're going to be what I think is likely an all-out financial crisis. This is why the Fed's cutting. It's because they're watching the 2-year Treasury yield, and they know if it continues to fall, they're going to chase it down, because when it does, it means they got it wrong. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.